It's now my privilege to formally welcome and introduce Governor Tiff Macklem. Mr. Macklem was appointed Governor of the Bank of Canada in June 2020 for a 7-year term. He first joined the Bank of Canada in 1984 and held various senior positions, including Chief of Research and Advisor to the Governor. He was appointed a Deputy Governor in 2004 and Senior Deputy Governor in 2010. During the global financial crisis, he was Associate Deputy Minister at the Department of Finance and represented Canada at the G7, G20, and Financial Stability Board. From 2014 until his appointment as Governor, he was the Dean of the Rotman School of Management at the University of Toronto. Friends, please extend a warm Saskatoon and Saskatchewan welcome to the Governor of the Bank of Canada, Mr. Tiff Macklem.
Thank you, Jason. Well, first of all, Jason, thank you for that wonderful introduction. Chris and Jason, thank you both for having me. The short version of my speech is your jobs are very important. So look, to all of you, good afternoon. It is a great pleasure to be here in Saskatoon. And I do want to thank the Saskatchewan Trade and Export Partnership and the Greater Saskatoon Chamber of Commerce for this invitation. Canada is a trading nation. As the Premier just outlined, we rely on exports for around 1/3 of our income as a country. And we use that income to buy things we need from abroad. And as you said, Premier, the share of exports in Saskatchewan's GDP is even higher. It's about 45%. It's actually the highest in the country. Saskatchewan provides commodities to the world: wheat, canola, potash, oil and gas, uranium, and more. And it imports a range of goods, particularly motor vehicles and machinery and equipment, mostly from the United States. Unfortunately, trade is under attack. Globally, trade friction has been increasing for the past dozen years, and now the United States has swerved sharply raising prices and putting the Canadian and global economies on permanently lower paths. These shifts in trade also have implications for international capital flows. Together with unsustainable U.S. fiscal deficits, persistent trade imbalances have the potential to increase financial stability risks globally. Saskatchewan, like most of Canada, is caught in the crossfire. New U.S. tariffs on steel, aluminum, motor vehicles, copper, and softwood lumber are hurting businesses and affecting workers across the country. But here in Saskatchewan, it's actually China's move to effectively block Canadian canola exports into its market that is causing the biggest trade impact. Around the world, trade is more fragmented. Trade with the United States is more difficult. Trust is low, and new risks to financial stability are emerging. As an open economy closely integrated with the United States, Canada is particularly affected. And that's what I want to talk about today. I'm going to begin with a longer-term perspective, outlining 4 megatrends in global trade and capital flows that are transforming the global, international, economic, and financial landscape. Global trade growth has slowed. The United States is no longer the dominant trading nation, but it still dominates global financial flows. And global trade imbalances are widening again. Now, President Trump did not start these megatrends, but his policies will likely reduce trade with the United States further and could dent the US dollar as the global safe asset. Then I'm going to discuss the implications for Canada and the world. Pour le Canada, les ramifications d'une nouvelle relation avec les États-Unis sont immenses. Et une chose est sûre, on ne peut pas permettre d'attendre. Les leaders du pays, chefs d'entreprise, responsables politiques et dirigeants économiques doivent tracer une nouvelle voie. On aurait dû faire ces changements il y a 15 ans. Mais le deuxième meilleur moment, c'est maintenant. Les États-Unis seront toujours un partenaire commercial essentiel. Mais il faut trouver de nouveaux marchés pour nos produits et nouveaux produits pour nos marchés. Il faut améliorer notre productivité pour être compétitif à l'échelle mondiale et on doit attirer les capitaux étrangers. Partout dans le monde, les nations et les entreprises cherchent de nouveaux partenaires. Le Canada devrait être en tête du liste. For Canada, the ramifications of a new relationship with the United States are immense. And one thing is clear, we cannot afford to wait this out. Canadian leaders, business leaders, political leaders, economic leaders need to chart a new course. We should have been making changes 15 years ago, but the next best time is now. The United States will always be a crucial trade partner. But we need to find new markets for our products and new products for our markets. We need to improve our productivity to compete globally, and we need to attract foreign capital. Around the world, countries and corporations are looking for new partners. Canada should be top of the list. So let me begin with the 4 megatrends. First, global trade growth has slowed. You can see this in chart 1, which shows global trade as a share of global GDP. And what you see is that in the first 65 years after the Bretton Woods Agreement was signed in 1944, global trade grew faster than the global economy. Open trade brought specialization, innovation, and economies of scale. It drove investment and productivity. For consumers, open trade increased selection and lowered prices. Trade spurred income growth across countries, reduced global poverty, and raised standards of living. But since about 2010, trade growth has slowed. It's no longer growing faster than GDP. Now, some slowdown was inevitable. Once most economies were participating in open trade, there was less capacity to expand trade further. China can only join the global trading system once. Still, part of the slowdown reflects shifting politics. The benefits of open trade have not been evenly shared. When low-cost producers in exporting countries undercut domestic producers, workers who lost their jobs lost more than they gained. This has eroded public and political support for globalization, resulting in a pullback from open trade. As a result, trade barriers have been rising for the past dozen years. And now we're in a new era of U.S. protectionism. As you can see in chart 2, U.S. tariffs have not been this high since the 1930s. U.S. tariffs are doing at least 2 things. They're reducing bilateral trade with the United States, and they're rerouting trade as exporters look for ways to get around tariffs and seek out new partners. China, in particular, has been ramping up trade with the Global South for several years, and this has accelerated with new U.S. tariffs. Have a look at chart 3. China's entry into the global trade system and rapid growth over the past 25 years brings us to the second megatrend. The United States no longer dominates global trade. Chart 4 shows trade flows between countries in 2000 and in 2019. The change is dramatic. In 2000, the United States was dominant. Now, the global trading network has 3 main hubs: China, the United States, and the Euro area. The global trade network has also become far more complex, much denser than it was 20 years ago. As China expanded its trade, it also moved up the value chain. 20 years ago, advanced economies were happy to buy low-tech consumer goods produced by state capitalism in China. Prices were low, which benefited U.S. consumers. But now, China is competing head-to-head with the United States and other countries in advanced manufacturing and high-tech. The global trade system is designed for private companies competing in an open marketplace. But in China, trade is being used as an instrument of state-directed growth that gives Chinese companies an advantage over their competitors. In response, advanced countries have increasingly embraced industrial policy across a widening spectrum of strategic industries. China's ascendance and use of industrial policy has also spurred the swerve in U.S. trade policy. As U.S. tariffs on Chinese goods peaked in April at about 150%. Now, since then, tensions have de-escalated considerably, but the effective tariff rate on China remains high at about 40%, and both countries have imposed export restrictions on some strategically important products. That brings me to the third megatrend. While the United States no longer dominates trade, it continues to dominate global financial flows. Chart 5 is the comparable chart for financial flows. The United States has the biggest equity and debt markets in the world. The size and dynamism of the U.S. stock market fuels growth companies. The depth and liquidity of the U.S. Treasury market, along with very low perceived credit risk, have made U.S. Treasury bills the global risk-free asset. This has increased demand for U.S. dollars and made the dollar the global reserve currency. Providing safe assets to the world has its benefits. The United States can borrow money to finance growing fiscal deficits at a lower rate than it could otherwise. For many global investors, the question now is whether U.S. dominance in global financial flows will ebb as the United States pulls back from global trade and runs large fiscal deficits. The recent performance of the U.S. dollar may be telling us something. Typically, we'd expect U.S. tariffs to support the U.S. currency, but instead the greenback has depreciated, and the price of gold, another safe asset, has risen. President Trump's Liberation Day shook global confidence, and the dollar's safe haven role was called into question. Stock markets have since recovered, but the dollar has depreciated by about 10% against other major currencies since the start of the year, and the price of gold is up over 40%. Now, it's too early to know if this is the start of a new era. For now, the greenback remains dominant, and without a clear alternative, I suspect it will remain the global reserve currency for the foreseeable future. But for many, its value as a hedge in times of stress has been dented. And President Trump's attempts to influence the Federal Reserve are raising questions about the independence of U.S. monetary policy. The final megatrend I want to touch on is the persistence of global imbalances. And by this, I'm referring to the persistent trade deficit in the United States and the large and continuing surpluses elsewhere, especially in China and the European Union. And you can see this in chart 6. International capital flows are the flip side of trade imbalances. To fund its trade deficit, the United States relies on net capital inflows, foreigners purchasing U.S. debt and equity, as well as foreign direct investment. In other words, the United States must attract savings from abroad because it does not save enough at home. In contrast, China and the European Union both have excess savings. Domestic factors are the main reason for the widening of imbalances between these major economies. China's consumption has been persistently weak. Households in China hold high precautionary savings because social safety nets are not well developed and the property sector has been shaky. In the European Union, investment has been weak relative to savings because opportunities are less attractive, especially in high tech. In the United States, it's the opposite. Consumption and investment are high, fiscal deficits are large, and the savings rate is low. So the United States is running a trade deficit, and the biggest counterparties are the European Union and China. Now, I want to stress that imbalances are not inherently bad. Global capital flows are part of a well-functioning international trade and financial system. But risks accumulate when the imbalances grow unsustainably and the necessary adjustments do not take place. Countries or regions with a trade surplus, in this case, China and the European Union, generally face little market pressure to adjust. Usually, most of the adjustment will be forced onto the country with a trade deficit, in this case, the United States. But because the US dollar is the global reserve currency, foreign investors have been willing to finance US spending. So imbalances persist. So why do we care? Because we've seen it grow wrong before. In the lead up to the 2008-9 global financial crisis, imbalances built up as China ran large trade surpluses and the United States ran large trade deficits. The U.S. subprime mortgage implosion was the product of flawed financial innovation and lax regulation. But the massive inflows of foreign capital to the United States made a local problem global. They sparked the worst financial crisis since the Great Depression. Global imbalances narrowed after the crisis, but they've started to grow again. Because of insufficient domestic savings, the U.S. fiscal deficit must be funded in part by foreign investors, and they could become less enthusiastic about U.S. assets. At the same time, U.S. government debt is increasingly being purchased by non-banks, particularly hedge funds, using highly leveraged strategies. This is increasing leverage at the very core of the financial system. These are vulnerabilities. And no, U.S. tariffs probably won't fix global imbalances. Lower U.S. imports from the rest of the world will likely come at the cost of lower U.S. exports. But as long as the United States is spending more than it's producing, it needs to import more than it exports. Okay, that's it for the megatrends. What are the implications? These megatrends, I took the time to go through this because I wanted to highlight that, yes, President Trump has really swerved policy, but these trends did not start with Trump. They have been building for some time. And now U.S. tariffs, combined with the unpredictability of U.S. policy, are increasing uncertainty, they're shifting relationships, they're weakening global demand, and they're reducing the efficiency of global supply. What are countries doing? Well, countries around the world are adjusting their supply chains and they're seeking new partners. China's reach into emerging markets is increasing. New partnerships support China's quest for a multipolar world where the United States has less geopolitical weight. The European Union is also making changes beyond simply diversifying trade. It's trying to tackle a number of its internal challenges that have hampered its competitiveness. The global economic fallout from the U.S. trade war has so far been milder than first predicted. And that's both because U.S. tariffs are not as high as initially feared and because retaliatory tariffs have been limited. But the full impact has yet to be seen. Many U.S. households remain cautious about spending, and U.S. employment growth has slowed. In the Eurozone, growth looks to be softening as U.S. tariffs weaken exports. In China, export substitution to Asian markets has offset the worst effects of tariffs so far, but businesses are investing less and growth looks to be slowing. So what can governments around the world do? Well, when the United States raised tariffs sharply in the 1930s with the Smoot-Hawley Tariff Act, most leading nations responded by erecting their own tariff barriers. The combined impact was severe, contributing to the depth and persistence of the Great Depression. This time, countries have avoided escalating a global trade war. That's good. But they could go further by strengthening trade ties where possible. Look, the era of open trade with the United States may be over, but the rest of us can still deepen trade with others. To do this, we need our multilateral institutions, particularly the WTO and the IMF, to work together to address the problems of unbalanced trade and lack of adjustment. Together, countries also need to be prepared for new financial stability risks. We need our financial supervisors to strengthen surveillance of financial vulnerabilities, especially as hedge funds and other non-banks play an increasingly important role in our financial system. Here, the IMF and the Financial Stability Board need to work together to identify potential systemic risks. And for their part, businesses need to consider both geopolitical risks and the resilience of supply chains along with efficiency. More industrial policy means chief executive officers need to think about how their corporate strategy interacts with national priorities. These national priorities may allow business to take more risk, which will fuel growth, but they should not be used to create monopolies. Central banks. Well, we also have a role to play, but actually it's limited. Monetary policy cannot undo the damage caused by tariffs. At best, monetary policy can smooth the path in the short run, supporting economic growth while ensuring inflation is well controlled. And that brings me back to the impact here at home in Canada, both in the short term and in the longer term. So first, the short term. Trade growth in Canada had slowed well before the re-election of President Trump. And if you look at trade as a share of GDP in Canada overall, it slowed in about 2000. But Canadian exports have declined sharply since President Trump imposed new tariffs on Canada and has created considerable uncertainty with tariff threats and reversals. The pain is falling primarily on key sectors: steel, aluminum, and motor vehicles. Last month, we saw tariffs increased or extended to more goods, including copper and softwood lumber. High tariffs are also being imposed on exports that are not compliant with the Canada-US-Mexico agreement. Here in Saskatchewan, actually most of your exports comply with CUSMA, as the Premier just said, 95%. So actually you're not being affected much by US tariffs, at least not directly. If the US slows, you will be affected by that, but you're not being affected much by US tariffs. You are, of course, being severely affected by Chinese tariffs on canola. The economic impact for the country has been a whipsaw. Growth held up actually pretty well at the start of the year, but that was driven largely because exporters were trying to ship as much as they could to get ahead of tariffs. That boosted our exports. This reversed in the second quarter. Exports dropped almost 27% in the second quarter, and GDP contracted 1.6%. The sharp drop in exports is hurting the job market. The unemployment rate rose from 6.6% in February to 7.1% in August. Here in Saskatchewan, as you're well aware, it's much lower, 4.7%, lowest in the country. But looking at the country as a whole, what you see is hiring and employment in trade-affected sectors is down sharply, and employment growth in the rest of the economy has slowed. Many businesses have also told us they've paused investment plans given the elevated uncertainty about US trade policy. Let me switch to the longer term. In the longer term, increased trade friction with the United States means our economy will work less efficiently. There'll be added cost, and incomes will be lower. Chart 7 shows the bank's assessment of the growth path for the Canadian economy before US tariffs. That's the blue line. And with US tariffs based on trade policy as of the end of July. That's the orange line. Remember the blue line and the orange line. Now, monetary policy cannot undo the efficiency costs of US tariffs. It can't bend the orange line back up to the blue no tariff line, nor can counter-cyclical fiscal stimulus. What could? What could is positive structural reform. Canada has a choice. We can live with the structural impact of a more protectionist United States, the lower path, or we can improve our productivity and competitiveness and bend the orange line back up or even above the blue line. Canadians have braced the power of economic patriotism. Elbows up. But now we need to roll up our sleeves and do the hard work to be more competitive. We need to diversify our trade by growing our internal market and finding new overseas markets. And we need to improve our productivity and make ourselves more attractive to investors. That work has started. And I've spoken about these things before, so I'm going to be brief, but hopefully clear. There are some things we could do quickly at little fiscal cost if we have the determination. There is momentum to eliminate interprovincial trade barriers. Saskatchewan has been a leader. We need to take a comprehensive approach that lowers the cost of doing business across the country. This includes removing trade barriers and many small regulatory differences. It also includes mutually recognizing provincial labor accreditations for many professions. We also need to remove unintended barriers to investment by shortening regulatory approvals and reducing regulatory uncertainty. Then there are other things that require investment and will take time to build. But the sooner we start, the sooner we will reap the benefits. Here I would include better east-west transportation links to grow our internal market and get products to overseas markets. I'd also include new port capacity to reduce our dependence on the United States. If we can get our products to overseas markets, we have some of the best market access in the world. Canada has trade agreements with 50 countries beyond the United States. But businesses and governments could do more to leverage these agreements. We need to learn from the past. The recession of 2009 highlighted just how vulnerable we are to a drop in U.S. demand. And back then, everybody was talking about diversifying away from the United States. But the reality is, not much happened. This time, we need to follow through. Finally, we also need to nurture and support our long-standing strengths. We have the ingredients to attract more foreign capital. We have effective governments and rule of law. We have abundant energy and other resources. We have a diversified industrial structure. We have a strong labor force, healthy participation, a good immigration system, and broad access to quality education. But our immigration system has been strained, and our university and colleges are facing a financial squeeze. We can't take our strengths for granted. Increasing productivity and improving competitiveness may not be every Canadian's biggest priority. But if we can bend the orange line back up or above the blue line, everything from housing to healthcare becomes more affordable. Productivity growth is what sustains increases in our standard of living. Okay, that was a lot. I need to wrap up. But before I do, let me return to the role of monetary policy in all this. Tariffs have weakened our exports and GDP growth. They've slowed the job market, and they've added costs. Monetary policy cannot undo the damage caused by tariffs, but we have a role to play, supporting the economy through this period of adjustment while maintaining price stability. Last week, the bank lowered its policy interest rate to better balance the risk we face as the economy adjusts to a new trade relationship with the United States. We are proceeding carefully, with particular attention to the risks and the uncertainties. And as we demonstrated last week, we are prepared to respond to new information. We will support economic growth while ensuring inflation remains well controlled. But as we all deal with the immediate fallout of global fragmentation and rising protectionism, business leaders, policymakers alike need to think about the deeper structural weaknesses that threaten the resilience of our economy. There is no better time than now to deepen investment, improve productivity, and expand our markets. We have the capacity to overcome the negative impact of new trade restrictions with the United States. Elbows Up has been galvanizing. Now we need to roll up our sleeves. There's a lot of hard work to do. Thank you very much.
Well, thank you very much, Governor. Thank you very much, Governor. We have a few minutes left, and we would like to spend some time maybe democratizing this event a little bit. We've got some time for a Q&A. Not very many Q&As, so I will suggest if you've got something that you would like to ask the Governor, you work up the courage quickly and find your way to a microphone so we can get to it. I appreciate, Governor, your ability to add context and distill the complexity of global trade into actionable items that feel like they can hit home in Saskatchewan businesses and homes. And you mentioned at the end of your presentation the action you took on the interest rate. And I want to talk a little bit about that to get started. And so the interest rate was historically low during COVID. And then following that, a rapid rise. And then now we're seeing a moderation back. I wanted to ask whether or not you think there is a natural interest rate for Canada and the economy.
Well, we do have a concept, a natural interest rate concept. We actually call it neutral interest rate. But I would warn that it's kind of a theoretical concept. We don't observe what this neutral interest rate is. We do try to estimate it. And when we try to estimate it, it's between about 2.25% and 3.25%. So at 2.5%, we're in that range. But I would caution that, first of all, we don't really know what it is, that we can't observe it. Second of all, what is this neutral rate of interest? Well, it's where the interest rate would settle if inflation was at target, the economy was operating its capacity, and there was no shocks buffeting the economy. Well, that never happens. And certainly, that's not the situation we're in now. Yes, inflation is close to 2%, but there's considerable slack in the economy. The unemployment rate, not so much here in Saskatchewan, but in the rest of the country, is sort of well above its normal level. And there's nothing natural about the adjustment we're facing right now, dealing with with our largest trading partner. So, what that means is that, as a practical matter, when we sit down and deliberate over interest rates, we're not thinking too much about the neutral interest rate. We're thinking about this disruption to trade. It's adding costs. I mean, many of you are running businesses, and what we're hearing from businesses is there are new costs. You're looking for new markets. You're looking for new suppliers. That has new costs. Your trade's getting disruptive. There's uncertainty. That has new costs. We have to make sure that those cost pressures don't become inflation. At the same time, the economy's weakening. That's putting downward pressure on inflation. We need to support the economy through this adjustment so we can keep inflation close to 2% going forward. That's where the economy functions well. So as we're deliberating over interest rates, that's really what we're focused on. We came to the conclusion last week that the risks had shifted, the economy had weakened further, the upward pressures on inflation were looking more contained. It made sense to drop the interest rate 25 basis points. So that's what we did.
Excellent. Checking to see if there's any questions on the floor. I don't see any just yet, so don't worry, I have more. You spoke today about, obviously, Canada's economy, the importance of where we stand in a fluctuating global trade environment. Can you talk a little bit about the connection between trade policy at a national level, foreign policy, and monetary policy, and how those things work together?
It's a good question. So first of all, foreign policy, trade policy, immigration policy, these are all policies of governments, elected governments. They're not policies of the Bank of Canada. We have no role in these policies. But all those policies, of course, they affect the Canadian economy, and so we need to understand the implications. And the reason I took you through sort of a quick summary of the last 20 years of global trade was to send the message that, yes, President Trump is having a big impact, but these trends have started before President Trump. They're not going away soon. There is a big structural change. This is not a cyclical downturn with a bounce back. It's a structural change. It needs a structural response from governments and from businesses. To come back to our role, the Bank of Canada, we're a stabilizing force. We're going to keep inflation reasonably close to 2%. We're going to do what we can to support the economy through the adjustment. We try to ensure that the financial system is working for Canadians, working for businesses. It's stable. The two other things I would say we do here. in order to take our decisions, we do a lot of analysis. So we've been doing a lot of analysis of what the impact of U.S. tariffs are. And we're publishing that in our monetary policy reports. I talked about it today. We don't have a crystal ball of the future, but certainly the analysis we're doing is helpful for our decisions, and we're sharing that with Canadians. Hopefully it's helpful for some of you in your business decisions. And then the third thing that we do is I meet very regularly with my colleagues around the world, at the G7, at the G20, at the International Monetary Fund, at the Financial Stability Board. We're comparing notes. We're looking at, yes, it's more difficult to do business with the United States. We're all facing that. What can we all do about that together? We're putting our heads together. We're trying to find solutions. Many of those solutions will end up being the responsibilities of elected governments, but central banks have a role to play to bring evidence to the table, to bring analysis to the table. It's non-political, it's evidence-based, it's facts-based. That's what we do.
Well, that's reassuring to hear. I think I will ask maybe one more question here before we wrap up for the day. And really, it's an extension of your call to action about rolling up our sleeves here, not only in Saskatchewan, but all of Canada. If you were going to give some advice, perhaps, to the business owners and operators in this room and across the province here today, what would you suggest that businesses can do or should be doing in this time of economic uncertainty, and how will the bank support that?
Well, I get asked this question from time to time, and I have to say I'm always a little reluctant to answer it because, look, you all know your businesses way better than I do. You know your markets, you know your books, so you need to figure out what to do. But I'll give you two bits of advice. One more in my previous role as Dean of the Business School at University of Toronto. One of the messages I had to businesses, there's always uncertainty. Right now, uncertainty is more elevated than usual. And we would all like to wait until, the fog had cleared, we had clear line of sight, and we were super confident that business opportunity was going to pay off. The problem is all your competitors are doing that too. And so by the time you wait till it's a sure thing, the one sure thing is that somebody else will have taken that opportunity. So, look, we're all having to shorten our horizons through this period of uncertainty. We're doing that at the Bank of Canada. We're shortening our horizon. We're more focused on the risks of uncertainties. But we have seen a bit more stability lately. I do think instead of publishing different scenarios, I do think we're going to get back to a baseline forecast. We're going to have to start being more forward-looking again, and that's what businesses are going to have to do too. The second thing, and I already mentioned this, what we're going through now, it's not like COVID. It's not like we're closing the economy and it's going to just reopen and bounce back. It's not like this is you know seasonal fluctuations better than anyone here in Saskatchewan. It's not like, okay, you got a bad harvest one year and it's going to bounce back the next year. It's not like a typical business cycle where you get a bust followed by a boom. This is a structural change. And if you go back, that's why I put that graph of the blue line and the orange line. The orange, unless we do something about it, the orange line is staying below the blue line. And governments have a role to play, but ultimately it's going to come down to businesses. Governments can try to help open some new markets and get trade agreements and build infrastructure to help you get product there, but ultimately you've got to go in and you've got to sell in those markets, and it's going to be harder. There's a reason we do so much business with the United States. It's easy. They're close. We watch the same TV shows. We cheer for the same sports teams. It's easy. It's now gotten harder, and that means that we need to make a structural change here.
Okay. One final takeaway: we got to bend the orange line. Back up. I get it. Thank you very much. Listen, I want to say thank you to everybody for spending part of your day with us today. Thank you to the Chamber and Jason, your team, for helping us pull this together. Thank you for our dignitaries for being here today, Premier Moe. But most of all, thank you, Governor Macklem, for taking the time to be here in Saskatchewan and share your insight and wisdom with us in the room here today. So thank you.
Good afternoon. My name is Rebecca Spence, and I'm a press officer for the Bank of Canada. I will be moderating today's press conference. Governor Macklem will be pleased to take questions for about 20 minutes. Before asking your question, please state your name and affiliation. We are webcasting this press conference, so please use the wireless microphone, which my colleague will bring to you. We will do one question each to try and make sure every news organization gets a chance to ask a question, because we also have some journalists participating remotely today. We'll start in the room, then go to the phones. The governor will be happy to answer questions in both official languages. Avant de poser une question, prière de vous identifier. Je vous demanderai également d'utiliser le micro sans fil. Libre à vous de poser vos questions dans la langue officielle de votre choix. So we'll get started in the room with Thea.
Good afternoon. My name is Thea James. I'm with allsaskatchewan.com. My question is, do growth risks outweigh inflation risks right now? And if they do, are you concerned about the evenness of growth across Canada?
Well, both risks are, we're watching both sets of risks very carefully. At our last decision, we came to the conclusion that the balance of risks had shifted. Growth had weakened further. The upward pressures on inflation looked more contained than they looked back in July. So against that background, we decided to lower our policy rate by 25 basis points to rebalance the risks. And I expect that when we get to our next decision, we'll be looking at those balance of risks again. There's a few things we're watching particularly closely. U.S. tariffs have had a profound impact on our exports. We're looking to see where do those exports go from here. Secondly, we're looking to see, given a much weaker profile for exports, what is the spillover to employment, to investment, to household spending. So far, we've seen uncertainty in particular has been really restraining investment. Employment has weakened. Unemployment's gone up. Consumption has been holding in reasonably well. We'll be watching that closely. Coming to the inflation side, what we hear from businesses are there are added costs related to this disruption in trade. They're looking for new markets. They're looking for new suppliers. They're rerouting their supply chains. That all has some costs, and that can get passed on to consumers. So we're watching that closely. And then finally, what's happening to inflation expectations. So far, they're fairly well anchored. So yes, and really, what's our objective? There's some role for monetary policy to try to help the economy adjust to this new relationship, but our primary mandate is to make sure that Canadians don't need to worry about a big change in their cost of living. Our primary mandate is to maintain low, stable inflation.
Thanks.
Hello, Keenan Sorokan with CTV. Not a lot of mention of Saskatchewan in your conversation here this afternoon. I was just wondering what sort of role the Saskatchewan economy plays in this new sort of economic reality you laid out this afternoon.
Well, Saskatchewan is you're right. The speech was very much about the big global forces, what's happening to global trade, what's happening to global financial flows. Saskatchewan, though, is actually a very good place to deliver that speech, because in Saskatchewan, trade is the biggest part of the economy compared to every other province. In Saskatchewan, almost 50% of the income that this province generates comes from exports. The other thing that's interesting about Saskatchewan is that, like the rest of Canada, the U.S. is the biggest single destination of Saskatchewan's exports. But actually, Saskatchewan is less concentrated in exporting to the United States than most other provinces. For the average of Canada, about 75% of the exports go to the United States. For Saskatchewan, it's just under 60%. So, a number of exports, potash, canola in particular, are shipped to overseas markets. Yes, U.S. is a very big market for those things, but it's not the only market. And Canada needs to do more of that. Canada needs to diversify its trade. Saskatchewan's, you look at a map, it's like right in the middle of the country, U.S. in the south, Alberta, Manitoba, around it. Yet it has managed to diversify its trade more than some other parts of the country. So it is a good place to talk about trade and what can be done to diversify our trade. The second part of your question is really the fact that different provinces are getting affected by tariffs in different ways. And yes, I mean, that is a reality. These tariffs are hitting specific sectors, steel, aluminum, motor vehicles in particular, softwood lumber, copper. There's new tariffs on copper. China's got tariffs on canola, on pork, on seafood. It's those industries that are being hard hit by the tariffs, and those, of course, are located in different places across the country. So almost every part of the country is being somewhat affected. Saskatchewan actually less than most, because most of the exports in Saskatchewan are about 95%, or at least 95% are compliant with CUSMA, and so they continue to be tariff-free. The biggest actually impact here in Saskatchewan is China's canola tariffs, which are very severe. Monetary policy is not well suited. We have one interest rate policy for the whole country. We can't target specific sectors. We can't target specific provinces. There's one interest rate for the whole country. But what can we do is, and really, fiscal policy is much better equipped to target specific sectors. What we can do, though, is that, from those severely affected sectors, there's spillovers to the broader economy, and so we can try to support the broader economy, which may help with this adjustment.
Eric?
Hey there, Eric Hertzberg with Bloomberg. I just want to ask you about housing. In general, we have rates coming down on the short end, middle of the curve, still a bit elevated on the 5 years. Just wanted to get your thoughts on where housing goes and how you're thinking about that in the future, particularly given that in the past when we've started cutting rates and trying to get some growth from the economy. It's been a major growth driver. It's also a major creator of wealth for Canadians. Moving forward, do you consider that to be the same? Do you consider it to be that?
Well, I mean, two comments. First, for many Canadians, housing affordability is the top of their list of concerns. And interestingly, although we've got very different housing markets across the country, almost everywhere you go, you hear the same message. Housing is hard to find. It's expensive, and that problem won't be solved by monetary policy. Fundamentally, if we want houses to be more affordable, we need to increase the supply of housing, and actually, fundamentally, we need to grow our incomes in this country. To get back to the main themes in my remarks today, the more we can grow our markets, the more we can reduce the cost of business doing in the country, the more we can improve our productivity. That will generate more income, and if you have more income, everything becomes more affordable. Housing, though, has a specific problem that we have not kept up as a country. We have not been building enough houses for at least a decade as a country to keep up with the growth and demand, and that has made housing less affordable. For monetary policy, you're right. Housing is very interest sensitive, and so when we change interest rates, that does affect the housing market fairly directly, fairly quickly. I would stress that we've had when interest rates were ultra low post-COVID, housing prices went up sharply. That made houses less affordable. We came out of COVID, inflation went up. We raised rates forcefully. That raised the cost of carrying a mortgage. That made housing less affordable. I think that the message here is low interest rates, we have a housing affordability problem. High interest rates, we have a housing affordability problem. We're not going to solve this problem with interest rates. It comes back to supply. We do take housing, what's happening in housing, as you said, it's part of the economy, it's an important part. We take that into account in terms of our decisions, but we have to look at the whole economy, not just the housing sector when we take our monetary policy decisions, and that's what we've been doing.
So that's it for the room. We'll go now to the call. I just want to remind people on the call to mute their line if they're not asking a question. We'll go first to Greg Quinn of Market News, then to Craig Lord from Canadian Press, then to Promeet from Reuters. So please go ahead, Greg.
Thank you. In your speech, you mentioned that recent events are raising questions about Fed independence. Well, I'd like to ask you that question. Is the Fed at risk of losing its independence, and why would that matter for the global or the Canadian economy?
Sure, Greg. Well, first of all, the first thing I would say that Chairman Powell is doing a very good job under very trying circumstances, and he is guiding monetary policy based on evidence, not politics. But the second thing, which I did refer to in my remarks, President Trump's repeated attacks on the Fed are a concern. The lesson from history is clear. The lesson, what you see in the research evidence is very clear. Central banks that have operational independence for monetary policy do a better job at delivering price stability for their citizens. And the second thing we know is that countries where inflation is low, and in particular where inflation expectations are well anchored, those economies perform better. Independence gives central banks the space to take difficult decisions that keep inflation low and benefit the economy. I would also stress that accountability goes hand in hand with independence. Central banks can't hide behind their independence. It's very important that central banks are accountable. Our legitimacy comes from being the mandates that we get from elected governments. It comes from being clear about our objectives. It comes from explaining our decisions and how our decisions will contribute to achieving our objectives. And then ultimately, it comes from delivering for our citizens. And with respect to the Federal Reserve, that's what the Fed has been doing under Chairman Powell's leadership. If that were to not be the case, that would be a concern. The U.S. economy is the biggest economy in the world. It has the biggest financial markets in the world. What happens in the U.S. affects us all.
We'll go to Craig.
Hi, Governor. Thanks for taking our questions. Why do you believe Canada fell short in the years after the global financial crisis when it comes to diversifying trade away from the United States?
I think it fell short. I think we didn't diversify as much as we could have because once the global financial crisis had passed, the urgency to do so went away. I think in 2008-9, the U.S. actually had a much worse recession than Canada. Banks failed in the U.S. Their financial system was clogged, even though they lowered interest rates and used quantitative easing. That monetary policy was not getting through. Our economy, no banks failed. Monetary policy was very effective, combined with fiscal policy. We did have a recession, but it was much less than the U.S. But most of the reason we had that recession was because U.S. demand for our exports plummeted. And it was a wake-up call of just how reliant we are on the U.S. If U.S. demand dries up, we get hit very hard. And, around that time, there was increasing recognition that we needed to diversify our exports. We needed to increase our linkages, particularly to fast-growing emerging market economies. I gave a number of speeches on the topic. Businesses were talking about it, others were talking about it. But as we moved away from the financial crisis, the urgency to do that faded. The reality is, it's been easy to do business with the United States. They're right next door, speak the same language. They've had rule of law. We watch the same sports shows. We watch the same TV shows. We have a lot in common. And just look at a map. I mean, geography matters. It's relatively straightforward to ship things north-south to the U.S. market. And so, those reasons, I think, sort of overcame the broader benefit of diversifying, and we didn't really succeed in diversifying. What's different this time is that our trade relationship with the United States has changed, and this isn't just a cyclical downturn. We're not getting a bounce back here. To the extent that this relationship is permanently changed, there's a permanent cost on the Canadian economy. And I think that underlines that this is a structural change. That needs a strategy for structural change, and that needs to involve diversifying our exports beyond the United States. I mean, look, the U.S., I expect the U.S. is always going to remain our biggest trading partner, but diversifying our trade with others would insulate to some degree. It could also help us get better prices for the goods we export, even to the United States. You've seen that with the TMX expansion. It has increased our ability to get oil to Asia, but importantly, it has narrowed the spread between WCS, the Canadian price, and WTI, West Texas, so that for every barrel we're exporting, regardless of where it's going, we're getting a better price.
We'll go to Promi.
Good afternoon, Governor. Thank you for taking my question. I will just extend on Greg's question. You've always been very guarded and conservative in terms of talking about Mr. Trump's interference into the workings of Federal Reserve. But this time you have actually spoken directly about it and what are the implications of it. Why do you think so, and why now?
Well, why I'm talking about it is that it's starting to have consequences in financial markets. In the week following April 2nd, the so-called Liberation Day, we all saw what happened. The stock market was down very sharply. Financial markets were very stressed. But something unusual happened. Usually when financial markets are very stressed, there's a so-called flight to quality. People pile into U.S. dollars. The U.S. dollar appreciates. The yields on longer-term U.S. bonds usually go down because so many people want to hold them. That didn't happen, actually. The U.S. dollar depreciated. Long bonds backed up. And that change caught a lot of financial market participants off guard. And as I said in my remarks today, it dented the U.S. dollar as a hedge in times of stress. And so what have you seen since there? Well, to some extent, the correlations have gone back to more normal, but I think there is a concern in the market that precisely at the moment when you want that hedge the most, it may not be there anymore, or it may not be as reliable as it was. The U.S. dollar is still the reserve currency. There's no question about that. There's no clear alternative, and I suspect the U.S. dollar is going to be the reserve currency for the foreseeable future because there's no clear alternative. But the value of a U.S. dollar as a hedge in times of stress does appear to be dented, and you can see in financial markets people still want to hold U.S. dollar assets, but they're hedging much more. Foreign investors are hedging much more of that U.S. dollar exposure. That's putting some downward pressure on the U.S. dollar. U.S. dollar is down about 10% since the start of the year. And other safe haven assets, particularly I'd highlight gold, are up quite sharply. Gold's up 44% since the beginning of the year. So something is happening. I'm not saying this is all related to President Trump's threats on to the Fed. The U.S. has cut interest rates recently. The market, thinks there's some more cuts to come. That's probably at play as well. But I do think you are starting to see some impacts, and in that sense, it's time to talk about it.
So we'll go next to Jordan from National Post, followed by Mark from the Globe and Mail, and Paul from Wall Street Journal. So please go ahead, Jordan.
Hi, Governor. Going off of an earlier question on housing, if monetary policy can't solve the housing affordability problem, what does the bank hope to achieve in including it as a focus in its framework review next year?
Yes, good question, Jordan. So, yes, I think I'm signaling that you have to be somewhat modest in your expectations on what we're going to be able to do here. But I do think there are some questions that we need to understand better. So we do, I think, understand quite well the interest sensitivity of housing on the demand side. Obviously, if you're a new buyer or you have a variable rate mortgage, a cut in interest rates, immediately reduces the cost of your mortgage. Similarly, increases it. And certainly the effects on the demand side are, I am very confident, much bigger than the effects on the supply side. But there may be some supply side effects through financing. Certainly when we talk to developers, they talk to us a lot about this. So I think we need to understand better sort of the full effects. And I mean, part of it is I think we need to do a better job of explaining how housing fits into our framework. Housing costs show up in inflation in a few ways. I mean, one of the reasons why inflation has been quite high, not last year, it's been pretty close to 2%, but if you look in the previous period, the very big increase in mortgage interest rates shows up very directly in inflation. When at the same, on the other hand, when interest rates are very low and house prices are going up, that also shows up in inflation. So, housing has different, and then there's rental accommodation also shows up in inflation. These are real costs for Canadians. Canadians are they're paying these. They're certainly housing affordability is a major concern about Canadians, but I think we need to do a better job of articulating how these different inflationary components fit into our inflation targeting framework.
Go ahead, Mark.
Thanks for taking the question, Mark Arnold with the Globe and Mail. You've spoken a bunch about the kind of structural shifts we need to see in the Canadian economy, and you focused on things like infrastructure building, new export markets, internal trade barriers, that kind of stuff. I haven't heard you talk much about industrial policy, which is a emerging topic we're hearing a lot from the federal government, whether that's in defense spending or efforts to try to create or find domestic markets for the export hit industries. And I'm wondering, what role do you see this more explicit industrial policy playing in this kind of structural adjustment you're talking about? And what are the inflationary implications of trying to find or create domestic markets for otherwise export-oriented industries?
Well, a couple of things, Mark. First of all, obviously, Bank of Canada, we don't do industrial policy. Industrial policy is the purview of elected governments. The second point I would make, though, is that industrial policy is coming back, and it's coming back partly for good reasons. When trade could be purely about efficiency, we didn't really need industrial policy. But once there are trade barriers, once there are risks that countries are going to, impose new trade barriers, or they are going to restrict exports of certain critical products, countries need to think strategically about what do they need as a country for their economic security, even for their national security. Trade isn't only about efficiency anymore. It has to factor in economic security, national security. If something is strategically important for a country, it may be in their best interest to actually make sure they have some home production of it, so they're not too exposed. I mean, those again are decisions that that elected governments need to take, not the Bank of Canada. What are the implications for monetary policy? Well, I mean, I think the broader implication is, when trade was all about efficiency, that was minimizing cost, and so the world benefited a lot from this period of globalization. Goods price inflation was very low for a long time, as supply chains, as businesses did a very good job of building really quite intricate supply chains with the low-cost producers in different locations, and then putting that together in a very efficient, low-cost way to build goods. In a world where supply chains need to be more resilient, in a world where there is a need to protect yourself from risks, there will be some cost to that. There's no two ways around that. But I think what we've learned is that, and we saw this during COVID, we're seeing this more recently now with disruption to trade, there's also some insurance value, and that avoids very bad situations happening. So yes, there is some cost. Insurance always costs money. There is some cost to that, and you have to, but it also has benefits. So yes, there is some cost to that. I mean, our job as a central bank is to make sure that, yes, there are going to be cost pressures in places. What we have to make sure is that does not become ongoing inflation, and the Canadians can continue to count on inflation around 2%.
And actually, that was our last question. So thank you so much to the Governor, and thank you so much to you all for participating today. Have a great afternoon. Merci.
Thank you very much. Good to be here in Saskatoon.